Good morning, guys. I should say good afternoon. I'm recording this 26th of May, 12:50 my time. So the last lesson, we broke down a lot of stuff. We spoke about things from volume, liquidity, time. We looked at aspects of the profile. So things like initial balance, value area. We didn't touch on things like point of control, for example, which we'll look at some of that today and its relevance when we use the profile to trade. So we're going to take a look at that, and you're going to see how helpful that is with positioning. We touched a little bit on bid and offer stacks, value. Obviously, I mentioned value areas, but we did touch a lot on where orders tend to cluster, so where liquidity tends to rush in, so where those market orders are saturated, in other words. So we covered a lot of ground, but today we're gonna, and if you haven't seen that lesson, which is lesson 1, please go back and watch that lesson, because it will open up a lot for you. It will open up a lot for you, and it will stop me from needing to go over things again. It will make the course framework a little bit more dragged out. Okay, so where do we begin? Right, so we're looking at a profile of corn, right? So, and again, like I said to you in the last lesson, it doesn't really matter whether you're trading commodity futures, you're trading currency, you're trading interest rate futures, whatever it is you trade, right? It's the same idea. It's not going to be any different. So obviously, take it as you see it. Every market is individual, but also the same. What separates markets tends to be the amount of volatility available in different markets at different points. Everyone today is excited about index futures because there's a lot of volatility, and that's very typical in bear markets, or bear markets that transition into bull markets. You tend to get a lot of volatility on the downside. That has created a lot of opportunities, especially for mean reversion type strategies. So you're seeing more and more traders getting involved in that. As I've said in the past, you are going to come across concepts that are very similar to what you might have heard from other people. And that's fine, because some traders are good in their own right, and they've picked up on a lot of the things that I've picked up on, and some traders had their training from the same places I might have had my training and tuition from, right? We all started somewhere. So as a result, a lot of their concepts that they've brought to bear is based on what they've learned in other places, and there's going to be similarities. However, you know, if you are going to target and say, oh, I've seen this before, you're going to target me and say, oh, I've seen this before, someone else done it. And that's fine. Other people will talk about stuff like this, but a lot of concepts here, I'm going to teach you how to use them in a way that you're going to be profitable. And I've said this in the past, that if you complete this lecture series, you're going to make money. If you do everything I tell you on this lecture series, you're going to make money. And if you don't make money, like I said in the past, you're more than welcome to join my Discord server, DM me. You should see it flashing at the bottom of your screen now. The Discord link, just put it in as you see it on your web browser, and that should allow you to join my Discord server, or put it in your phone, whatever your medium is. Right? And if you join the Discord, you can DM me, and I'll personally help you get to the stage where you can think you're profitable. But I'm pretty sure these videos are going to be more than adequate. I just need to put that out there. Obviously, I have done another lecture series that encompasses a lot for people who want to become professional traders, for example, and that's my professional trader program. The market profile series is also for people who want to become professional traders, but it will allow you as a beginner to come into this in the right way. So the first time you see market profile, this is the way to go. Right? It will save you so much time because of the way the profile is designed. And I covered a lot of that in lesson 1. In this lesson, I'm going to be a little bit more direct now, and let's talk about some of the concepts that we're going to need to know 100%. And as I said in the past, if you don't have access to this tool, I will leave a link in the description below. You can also go to the Discord server and DM me to get access to it or access it directly on the Discord server. It is super important because I built this myself for MetaTrader 4. It's not available for MT5 just because it's too difficult to do. Other people do them, Sierra Charts, Ninja Trader, I think, but it all costs money, right? TPO is not for free. It is a very credible institutional tool developed by some of the smartest people at the time on the Chicago Board of Trade. It was designed for floor traders, who a lot of them still use it today. You're going to be hard pressed to find someone who's going to criticize the profile as a useless tool. There are a lot of useless tools in trading. This isn't one of them. So if you're not using it, not a problem. You can still use candlesticks. Like I said in the last lecture, I still use candlesticks, especially if I need to go back several days, right? So if I need to look at like 500 bars, I can't have 500 profiles. Some platforms might allow you to do this, but after a while, you're going to end up paying for data. So, and when I say you end up paying for historical data, right? So again, it just depends. I can get reasonably a 42 look back against every profile section. Some of these brokers don't even have enough data. If I was running like monthly profiles, I wanted to go back 42 months, I might not be able to do it. But I can definitely go back quite easily 42 weeks. So I can get at least 1 year's worth of data in profile format. That is gold dust as it is. Like if you're an intraday trader, swing trader, this is more than enough. Right? This is all you need in order to be able to make considerable progress if you want to have a bit of a look back or a bit of, mainly to look at levels, because it's really easy to back test with a profile. So if you're thinking about strategy, you're going to find that the techniques I'm going to show you are going to not require you to do too much back testing. You're literally going to be trading forward, which is where you want to be. Right side of the screen, not always left side of the screen. Right? So if you're at the left side of the screen, you're just looking at levels. So moving on, we're looking at corn, right? So this was close of corn on Friday. It's Memorial Day today, so nothing more active. So typically, a couple of important pieces of information. We've got the point of control, which is very relevant to me when we're dealing with commodities like corn. Bid stacking and offer stacking, which is where the volume is. So if we go back to my trifecta method, volume, liquidity, and time, or let's say liquidity, volume, and time, right? 1, 2, 3. When we look at a profile chart, we see volume on a horizontal plane. So any overextended profiles is going to indicate a lot of volume traded at that level, and it should provide significant support, right? We can see that here as the market traded down into it. Now, these of course are specialist markets, so the participants here are not always here as speculators. A lot of them are here as hedgers, right? So they produce corn or they produce a corn derivative, and they need to hedge their production capacity by buying futures in some cases, right? Or they need to sell futures depending. So this is a specialist market with specialist entities, and a lot of these are going to be farmers, people who need to deal in these markets, but more from a hedger's point of view. That said, there's also a ton of speculators as well. So fair price, point of control, really relevant. Bid stacks, offer stacks, really relevant. Right, so you can delete some of this off for now. So how would I look at a typical intraday? Right, so I've got my reference point. Right, so a couple of things stand out if you've been following the lessons. We've got a responsive buyer, or let's say an initiating buyer. Responsive buyers tend to be at the top. So let's say an initiating buyer against the prior day's value area. So someone who's willing to take a position at a high side of value the prior day, with the expectation the prices are going to go higher. So we're going to split this profile so we can get some context, and then we'll come to the next one. So this is the opening print, right? So this takes us back to 3 o'clock in Europe, which effectively is 1 o'clock in London. So 0100, we get the market open for corn, right? So we push lower and we trade around and so on, right? So this is pretty much the pre-market. And then we're going to come into the regular trading hours, which would be Z period, right? So that's 2:30 NASDAQ open, but also when we start to see the agricultural commodity markets open. So they have a clear open, regular trading hours, and that's 2:30 in London. I believe in New York that will place it about 9:30. In some parts of the US, 8:30. Just depends on where you are. So that's when these markets open. Once we open, then now we're in the regular trading, and come what may at that point. So whenever you're assessing a trade like this, there are a couple of things. The first thing we're going to look for is, where did the market go initially to look for additional liquidity? Now, we have said in the past that liquidity is market orders mainly, right? Because this is kind of a hidden liquidity. The brokers, they know where your stops are, right? But no one else does. So think about how much money people will pay to know where your orders are, right? Where there's going to be natural liquidity. So let's say someone is long, where they're going to put it. So let's say we're long in G period, right? So you were pre-market long, you're expecting the market to go up. Your stop is likely going to be at a significant low. Let's say at this place, let's say you got in a G period, you're pretty early, you might put your stop somewhere down here, right? Which will be, let's say, 50 cents, 60 cents, maybe even a point, right? Which puts it down here. Typically, these are the kind of things that people like to do, speculators. 1 point stops on a commodity. You get maybe 10 contracts in there, $50 a point. It's $500 a point, right? Typically, that's what your typical day trader wants to do. So from where we are, we're going to see a lot of stops below the low. And that's perfectly fine. So what we want to do is we want to mark this significant low. Right, I've done it this way because the G letter prints when we tick into 458, so you get the next G and so on. Right, so this is not actually the low, this is actually the low of the print. Right, so I like to draw it that way so we can see that that's where the print started, so anything below that print will be the next print. So if we know that already, actually I'll pull this down for argument's sake. Let's just sit right here, and that's the next print. Right, so we can see where the print happened, and if we trade down here, we've put in another print. So we know that underneath here, there's going to be a degree of liquidity. That's the first thing, and this is pre-market. So we can see that at 12:30, we have a big jump into the highs, and then we open the market here. What do? So initially, we trade the liquidity down here in U period, and then in W period, we pop up. That was about a 3.5 point move, right? It's a decent move. If you had a 1 point stop, you already made some good money. And that's looking at the liquidity concept. So why would someone want to buy here is the question. Well, I made the example as a long, and I've used liquidity to justify it. Split the rotation so I can see the individual auctions, and this is 30-minute rotations because I'm looking at corn and I want to see every half an hour because I know that the corn market opens at 2:30 in London. So I want to know exactly where we're trading on each half an hour rotation. So I've seen the pre-market, we saw a drop here. It looks like we're bearish, but in reality we're bullish. And the reason for that is that we've got what we call a bid stack, which is a lot of volume trading the prior day at this level. So there are a couple of things now I'm looking at, is that while we're very low on a pre-market, typically in these specialist markets, when we open, we're going to see the market run to take orders, which will be sell stop orders down here, and those will be converted to market orders to sell to someone else, right? And then the buyers are going to be able to buy at these cheap prices with a ton of liquidity. And that's because the earlier longs had decided to go long, but they've put their stops a little bit too tight, and the brokers, they know where they are. So when they get contacted and say, well, I need to buy at this price, they can exactly count how much liquidity is at that price and say, well, we can get you that price. We're going to have to bid the market lower. And that's exactly what happens. They bid, they collect that liquidity, and then they close higher. Right? So that's the first indication, obviously, that we were going to go long on the day, is the fact that we traded into this level and then we had some support down here. Right, so it's a high probability trade. So how would you execute something like that? I'm going to make the assumption that you waited for regular hours and then the market started to pop lower. The thing about the core market is you would have had a chance in a smaller time frame to visualize this thing drop. And if you're looking at market profile, and let's say you didn't even change time frame, you're still going to be able to see this drop. Right, so either way, as soon as we get into these levels and then we start to struggle, your default behavior will be, I want to get long, right? So you cross under the low. So this will be, again, there will be stops down here. So that will be that late pre-market low. As soon as we came under it, we hit that level and we start to go there, you want to be executing immediately on the downside, right? And how can we risk manage it? So there's a couple of ways. Now we can go for typically a 2-point stop, which is what I like for these assets. 2-point stop is a good stop. Or a 1.75 point stop is also a good stop, right? That's the first thing. And then we want to play this to the upside. So again, that's another example there of a liquidity model. Equally, because it's a specialist market, when we get to the upside, we're also looking for a similar play, right? So, oops, let's line this up a little bit. Right, so we're looking for a similar play. So if we get up here, right, in this case we dragged through and then we held. Well, again, what I'm looking for is for this to pull up a little bit. So we close down here, so just want to get ourselves up a little bit, and then I'll be looking again for a 2-point stop. In this scenario, you can see it would have been very tight. There would have been a chance that your stop might have been clipped depending on the way you executed. But there was always another opportunity to get back in. Now, each of these trades are yielding approximately, so if we took the trade from down here, just sliding back into the value high, which would have been about here, you're looking at all the way back was about 4 points, right? So you're making about double. So if you went the other way, you might have lost 2 points. You made 4 points, you lost 2 points. And if you went in again on the tread and you were prepared to hold overnight, you would have come back down the other way again. Right? But I'm going to make the assumption that, you know, as a trader, you may be new and you're not, you know, you're happy with just the one way. That would have been a good day. 4-point run to the top, close your machine, walk away. Right? Don't need to play it back the other way. You've done what you needed to do. Now we can also see there was some buy side strength here, so we're expecting that's good support, and that aided the idea that the market was going to go long. So if you see what we've done here, we've looked at the prior day, the behavior, open, higher close, lots of demand, volume, bid stack. We've seen the market come in, cover any inefficiency, in this case a gap in value, right? And we're going to talk about those, but not yet. And then we've come down, we've traded that level, and then we've come back up and then traded the pre-market high. Right, so typically that's, you see these a lot with these kind of assets, but it's not just corn, you see these with other assets too. Right, so that's example one. Right, so let's close this for a second, right? Move on to the next day. Again, what do we see the next day? We've got volume down here, volume down here. So this is going to be a large block of volume. The market's going to have to do a lot of work to get through these levels. This was where we found the liquidity the last time. So the big buyers here obviously going to have liquidity down here. It's going to be a good reference point. So we should be able to find some liquidity, of course, at the lows of the prior day. Obviously, we've worked our way to the top. So it's my general expectation that if we're up here, we should be able to trade back and take the low. So again, if we looked at split the rotation, and that gives us a clear look at the prior day. So we know that there's a lot of volume here, so there's a lot of stops down here, and that's where we expect the market to run to. We've already seen that we've taken the high, we've gone up, and this is the pre-market from the prior day. So how do we look at this? Right, so again, you can see the pre-market levels formed. If we draw a line at the top, any trading at the top, we would assume that it's looking for stops. And then we can see the same at the bottom. Any trading at the bottom relative to the prior day, we're probably looking for stops as well. Right, so what happens? This is pre-market, right? So we go up, O period, and then we trade lower, R period, we go back up again, just about to the pre-market high, and then we close lower. Right, so what's that telling you relative from the prior day? So we went up, liquidity traded higher, and we failed to take out any liquidity above the C period high the prior day. So the liquidity model is now breaking down in favor of the short side because we're no longer looking for buy stops in this case above the highs, right? And that tells you something. Well, the brokers have clearly communicated to the bigger entities that there's no liquidity up there. So if you want to get short, you best get short now because that's all you're getting. So all the liquidity would have likely been drawn in an O period, and that was 10:30 in Europe, right? So in London, that was about 8:30 in the morning. So that was during the London session, right? So that London pre-market, that London open in corn was where all the liquidity was drawn from. So that goes back to our time element of our trifecta, third trifecta, time. The time we trade is relevant. Notice that I'm only looking at the regular trading hours open. Typically, I'm not really trading in the after hours session because anything post O period, which is the London type open, we're not really going to get much going on. And as you can see, in all of these sessions, we start to get a lot of activity post O period. And W period, which is 12:30 in London, and that's pre-market in the US, is when we tend to get a lot of movement as well. So time is a factor. So if we're looking at these periods, we know that we're going to get a big movement. And now we've got a big movement and we're closing lower. So what are we expecting? Based on the typical range that corn tends to do, we're going to be looking for us to go back down to the prior day's open, right? Or the hour of the half an hour of the prior day open, which is the Z period low down here. Now we also know that there's buy side liquidity here, so buyers are going to be standing here ready to lap this up. So seeing where we are on the delivery, we haven't even opened. You can start to deduce that this is a low risk pre-market trade. Now, how would I do it? Now, if I'm seeing this trade, and I'm going to trade this into the open, then with this big drawdown here and a close, I'll get short with stops above the high. My expectation is if I'm wrong, we're going to draw the liquidity in U period, and then we're going to bounce back up again. But the truth is that so close to the open, that is not a likely scenario. But let's play devil's advocate. We can always be wrong on a trade. I'd like to have my stop here, which is just about 2.5 point stop. And I'm looking to get this down to the open, right? It's about 5.5 points, give or take, right? That's what I'll be aiming for. That would have been a good trade. And if I look at that against the profile, it opened up a value trade here, which is what even made it likely. Value trades have a 70% probability, and we'll discuss that. And also we'd seen a sweep of the liquidity at the top or let's say we could see the stop orders being activated, and look at all that volatility. So it's clear that we had a lot of activation on the top side, and that all played through into the pre-market and then came down. So we're now starting to see the market as one collective structure, right? So this is across 2 days. And what happened? We traded in, we closed above in C period, right? And then rallied. So again, this would have been a move into the open, and then away you go. Or let's say that you'd come into the open and you didn't trade the pre-market, and then we ended up opening, so this is the open, 230. We pushed down and closed lower into that bid stack. Well, what I'm looking for at this point is, let's just get under the low of A period, and I want to be a buyer. So let's say we're a buyer about here. I'm looking for about a 2-point stop, which puts me down here. And then I'm going to look for a rally. This was about a 4-point rally, right? So it's a small trade, but getting to E period end of the day, you don't want to carry this forward. So now what's likely to happen when we come back to the core market? There are a couple of things that are going to happen. First is we're going to deliver, right? So we're going to essentially see the market going higher, and then we're going to trade the high, right? So remember there was this big flush here. So we're looking for the market to trade above the high here, right? So we're probably likely going to see that kind of delivery in the pre-market. Now, if we don't see that in the pre-market, then our expectations are that we're going to attempt to draw on the liquidity down here. Right, so we've got to watch that closely on the market open. Now, considering the range that corn can often do, the pre-market will be a good tell. Right? We still know that there's volume down here, and the market's responded to that. Now, that will be the first level we'll look at. The second level will be, if we get an extension of volatility, is that we try out the liquidity down here, which will be the more likely, right? That will match up with the range of corn that we're going to do. Right, so that gives us a bit more perspective. So we know that already, and if we look at what's going on here, you can see that we have a build-up of bids. Right, let's zoom in a little bit. So you can see at that level that there was strong buying here. So this should hopefully be of interest in the future. Right, we can see that quite clearly. So again, if we just mark it out this level, so this is where we're going to start to see buying. So as soon as we get into this level, right, it's $4.50, the $4.52 mark on corn, then we want to start looking at potential buying interest. But we can assess that coming in. So we've got two things we're looking to do. So if you're going to plan this trade, you're looking for a market to come up here, draw on some liquidity late in the day, and then weaken. And then we're looking to short this back down to the lows. Again, from here, it will be a nice, neat little value trade. Or we're looking for it to open, trade lower, and draw on the liquidity, most likely under the pre-market low at this point here, that V period, right? So we're looking at those levels, right? So those become how we want to plan our trades. Typically, it's always 2-point stops. When you're dealing with these agri-commodities like corn, I like a 2-point stop. If I'm dealing with soybeans, I like a 4-point stop. So again, you kind of just mirror your risk based on the volatility you're experiencing. Right, so here we've had a 1, 2, 3 day look back into potential that this market can go to. It's pretty simple. So I've demonstrated how we can come and trade the core market and do exactly the same things that we've done in previous markets, using the very same trifecta approach and not really changing it. Right, so what have we learned? we've learned that those levels where those stops are hanging, right, that's information. And that is true in every market, that there's always going to be a fight for information, and the person who can bid the highest is going to get the information. So your stops or your market orders are information. Now, stops are particularly important because you can't see them. The only person who has access to them are essentially the brokers and the market makers, the places where you tell them that you want to put a stop in. No one else does. So if you're a hedge fund or you're some other entity and you want a lot of the asset, you probably want to find out where those stops are. So I have no doubt that money changes hands to get this information. So if we already know that that's a possibility, even if you don't believe that, it's not really relevant, is the fact that that information exists. Just assume that someone's going to have access to it and they're going to use it to their advantage. I mean, it'll be foolish for them not to do it. So the truth is that we want to pay attention to all those highs, so highs of day where people are likely to automatically feel safe. We want to pay attention to time when the market's open, so those key levels, especially pre-markets when we deal with these commodity-based markets. And then we also want to pay attention to where the volume is, so where there's bid offer stacking, for example, that's real volume. And then let's talk a little bit more about the point of control, so that fair price. So the fair price is where you'd expect the market to go, right? Because that's the fairest price, so you expect it to be traded out. Most efficient markets would see their fair prices completely traded out. So the way to prove that is to have a historical look back and see where fair prices are that haven't been traded again. This is a good benchmark on how efficient that market is. So for example, we have what we would call a naked point of control. So it hasn't been traded before. That's why we call it naked. And that's down here. So it means that at some point we expect this market to trade out that fair price. So we can immediately start to understand that the coin market's a little bit out of whack. And sooner or later, we're going to have a bearish run. Right, and there are ways we can look at that on a longer term cycle to kind of determine where corn is in I like to say it's 30-year cycles. Corn goes through 30-year cycles where it has like a step up increase in value. Food is an inflationary based asset. Obviously, food land is becoming scarce, food production techniques are improving, but there's more and more demand for food at higher prices, right? So my expectation is that whilst the future of corn prices is likely going to be higher over 30-year steps, but the reality is that we're going to trade the highs and lows of those cycles over a given 30-year period. And I'm going to illustrate this to you in another lecture, but for now, let's just keep with this. So I have that piece of information, so I know that, okay, it's possible that we're going to see corn prices down here for sure. And if we have another historical look back, this was a naked point of control at one point. So if we just mark it off, and as you can see, corn prices came back to trade that level. Right, so again, we also have naked point of controls even higher, right? And that will take us to quite extremes, right? And so again, we need to know where the market is likely to go first. In my opinion, I think it's going to go up first before it goes down, but again, it may well go down and find these closer naked point of controls first before continuing higher, right? So there has to be a degree of efficiency. The only way I can measure that is by looking at the fair price, right? In some markets, it's going to be more efficient than others, like currencies, for example, wherein the fair price gets traded quite quickly. There's not too many of these left naked, but in commodity markets, index futures, I find that that's not the case. The fair price is less traded, and it could go for a few days, even weeks before coming back there. So we hope that makes sense, right? When we start to think about how these markets, sort of the pricing mechanism works, and what essentially the whole idea of trading is about, and what people tend to look for. I like to have an intellectual discussion about trading, because often people think about trading like, there's all these million strategies, and they all can work, right? They all need edges. If they have edge, they work. But people think about the market largely like it's just crazy disorder. And I think in my last lesson, I explained to you how this particular quant trader tried to simulate the market, like basically recreate the existing market. And he did that by removing the amount of makers and just essentially making the takers, i.e. retail traders or traders in general, makers, i.e. market makers, they essentially made them less and then made the takers more, just placing random trades. And that essentially recreated the markets we see across all markets. And then you got this pricing mechanism now that delivered based on randomness. And it looks exactly like any other market. It's absolutely insane. It was one of these bizarre videos that popped up on my YouTube feed, and I decided to have a watch. And it was fascinating, right? And I've read a lot of intellectual books. I'm from the finance industry. I've read books on market microstructure and all kinds of things. But this kind of proves the point that markets have algorithms that are essentially pre-programmed to create a pricing mechanism, right? To deliver price. They're essentially pre-programmed to do it. So it really doesn't matter what you do. You just have to understand how those algorithms go about finding the liquidity they're programmed to find, right? Essentially, those makers are just looking at these random traders placing orders everywhere and then telling the algorithm, well, go there, go there, go there. So whether you got 100 contracts, you got one contract, it doesn't matter. Ultimately, the algorithm will go where essentially its creator wants it to go, right? And it's all going to be random. All the actions you take are random. The algorithm, though, its actions aren't random. They're based on math, right? So that's it. The algorithm is purely mathematical. So if you know that and you understand that, you know that the markets have a particular rhyme and reason, right? And you've got to follow it. It doesn't matter what strategy you're using. If you don't follow those, then, well, it is what it is. You're probably not going to do very well. And secondly, you need to be able to manage money very well. And we'll talk about it. We've already had some discussion around that today with the core market. Okay, so we've discussed the fair price. We understand that it has to be traded. Nakeds often don't stay naked for long. So that's one way we use the point of control of the fair price. Obviously, the fair price is going to be in the middle of a bid stack for sure, right? Because it's the mode price, it's the most traded price. So it's going to be in the middle of a bid stack or an offer stack. So we know that the point of control is also a volume indicator. It indicates the volume that took place at a specific price level that was particularly high. So below that would tend to be a lot of liquidity, especially in assets like commodities. And again, above that tends to lead to also, below and above, depending on direction, could lead to breakouts. What do I mean by that? So for example, if we were to start to trade below $4.50 on corn, then we would expect that we're going to enter some kind of bearish trend. So, or let's say even we manage to hold below this bid stack here, it could open up a break of these bids here and back to value. So big runs are going to start when we have those huge breaks. I'll give you a really good example. So let's take a look at these profiles. So we had offer stacking, close lower, bid stacking. So we know buyers are supporting this market, sellers are here, it looks like they're offside. How would I know if they're offside? Well, the market has to break and hold above their level. Now I know that those traders are offside because it's obvious that buyers came in here, sellers seemed to overcome them, but buyers came back in and held the day. So whilst you might have been wrong seeing this push lower, and also it would have been relative as well to the entire move down, so you'd already be too short. But let's say you were looking at a short side at the bottom of the market, then you can clearly see that on this day, you know you're offside by the time we close the day. Because you can clearly see that these sellers are in grave danger at this point because everyone's short at the lows. It's pretty much done. And why, again, there are other things that should have stood out to you, and that's the point with good tuition. If I split this profile, right, you can clearly see that at this point, we were below where typically we like to see those runs on the market orders. So these would have all been sell stop orders being triggered, right? And you can see during the pre-market, we delivered this price all the way back to those prior day regular trading hours, right? The pre-market is quite weak. So what did we do? We delivered all the way there and then came back down again to retest the pre-market low and then close higher. So there was clearly the market telling you that I'm going to take all the liquidity below the prior day regular trading hour open, right? Which was the Nasdaq here. So again, we're seeing that time relevance, that the orders that were sitting on the market open down here were more valuable, and we had a shitload of them, because you can see the first rally, the second rally, the third rally, and then the next day the takeoff. Not very hard to deduce. So if we condense all the profiles, we can see how this picture came to form. Crucial. All right, so again, we've seen at play liquidity being an important factor, those hidden market orders just coming alive. And we can also see the time also being a factor too. So we've got liquidity and time playing off each other. And then we're seeing volume, right? So that offside side of things, we got offers here. So those sellers were obviously wrong. And we can tell because the market went for the seller liquidity down here and then moved up. So the moment we broke above, it's all a consequence of this behavior, right? So all these pattern traders can easily do stuff like this and go, oh shit, that's a breakout. That's a consolidation wedge pattern. What's it? Yeah, that's the word they call it, wedge pattern. Consolidation and breakout. Right, so we've got this shift in, what they call it, shift in market structure. That's the word they like to use. Right, so you've got this shift in the market in general. So we've seen a big, huge profile trend day, locked at the top. Well, in a commodity market, you see something like that, you're looking for the opportunity to be buy side the next day. We could go lower initially, but we've got this nice little bid supporting. Clearly, it's taken out a hell of a lot of offside traders. I don't think anyone's coming in to short this market the next day. Really important, guys. So this is some of the deductions we can make, right? And I'm making this using a call market. Right, so I'll do one more example, and I'll use a completely different market to illustrate exactly what I've been trying to illustrate. So I'm deciding, eeny, meeny, miny, mo, do I want to go with crude oil or do I want to go with cable? Right? Well, I haven't really touched too much on currency, so I'll go with cable. Right, so I pick that rather randomly. So we have a similar scenario, right? So we can stay right side of the chart if you like. So we go back to 3-day look back. Right, so initially, let's open this, and we know what happened yesterday. So here we are. Same thing. Market opens, Asia session trades up, hits value high, trades down. Right, so we establish a low and a high. So if we draw a line under here, not rocket science. Not rocket science at all. So this is the low. L period, 11 a.m., so that's 9 a.m. in London, 12, 10 a.m., 11 a.m. So this is kind of a pre-market in London. So we've gone up, come down in Europe, traded the liquidity, did a huge move in O period, and we held, right? So this is 12 noon, pre any important data, right? So we held. So what's the intent of the market at this point? Is that we're going to probably go to the high of the Asia session, which we haven't really traded above. And we do know there's going to be a ton of stops in there. So we've seen that liquidity come in, the market's gone and held, and then we see in P period, we come down and hold in Q period. So if I wanted to trade this, right, this for me would be an overnight trade. I'll say, well, there's a good chance, so let's do this again. We got volume down here. I'm going to use the word volume and bid stack and offer stack interchangeably. Right, so we got volume down here. We've got what looks like a responsive seller here, so we know that anyone short this market is going to have their stops here, and if we take that level, we're likely going to have a run on those stops, and it's going to be a big move, right? There'll be a lot of people here with stop orders, and as the market orders coming in, essentially with people asking to buy themselves out of their position, right? Cover their shorts. So we've seen the draw, we've gone down, we've hit the liquidity here. It is also a significant level because it's prior day value low. So this is the lowest fair price available if you're an intraday trader. So most people, their indicators and a lot of things are going to be triggering at that point. So if I was going to trade this on the O period close, P period hold, which would essentially be the New York, I'm anticipating a strong NASDAQ open to the upside. So I'm going to get long at a low of Q period, and I want to be able, I've got two options. If I want to carry this overnight and I'm expecting a big move, I can go under the bid stack for stop, right? That's going to be a good protection level. Or I can sit just under the pre-market low from on the current day. If the NASDAQ holds up, we're probably not coming down there the next day, right? So it's a strong level. So I'll probably sit here. That's about 22 ticks or 22 pips worth of risk, right? On a 1 lot, that's $222. On a 10 lot, that's $2,000. So whatever your size is, right? Now, the thing about this is that if it works, we're going at least to deliver to the high of the prior day. And that's where my target would be. Because I know that high I know if it goes, it could be a strong move, but I also know that it could pull in a lot of sellers. This is where we can start to look at longer term cycles, where the pound's going to go, what it's doing on the daily against another period or the weekly. And we'll talk about that in a future lecture. But for now, that's what my goal would be. So let's split this profile. And if you look very closely, right, we open Asia, we break the initial balance in Asia very, very quickly. So, again, the initial balance is that first hour trading, right? So we break that very quickly, and then we move higher, right? Very quickly, we've taken out the prior day's Asia high. That's normally easy to do into a European session, and then K period, we close above. So my goal would have been to be getting out my trade about here. It's about a 60 pip run against 22 pips. It's nearly a 3-to-1 on a risk reward basis. Like, you've got nothing to worry about. So again, the time factor was crucial because I'm looking to get into this trade at the NASDAQ, which was 2 p.m. The NASDAQ hour. NASDAQ opens at 2:30. But at 2 to 3 window, I'm looking to buy at very cheap bid prices with stops below the pre-market, or getting in before the NASDAQ in anticipation and getting an even better price on that level. But there were multiple opportunities to buy the low of the P period, Q and O period print, multiple opportunities, and then you're positioning for an overnight run to exit the trade into the European Open the next day. That's what an overnight trade looks like for me. So time again becomes a factor. The time I get in, the time I get out. I don't want to overstay my welcome past Europe because US could have a different plan, right? 3 bullish sessions is always really rare, especially in currency. So I don't want to play that game. I want to get out as soon as I can, right? So I'm going to carry that trade to Europe and then liquidate it and move on. But that was a good trade. That's how I would have traded that day. Now, if I close this, I've gotten some reference information on close of play on the day that these could be sellers, but depending on where the Asian market goes against the balance, it will confirm to me they were buyers. But look how the liquidity model has allowed me to start to perceive that those guys are most likely buyers, right? Based on that intraday behavior. And that's drawn in a lot of volume. And I know that if we start to trade above that, then a lot of these people are offside, including the people who are short on the day. Very simple, not difficult. The concept remains the same. I'm working a lot on the left side of the chart. Okay, so let's go on the right side of the chart. I think in my last lesson, I spoke about that. I said, well, judging from where we're stabilizing, coming to end of day, the likelihood is that we're going to get a breakdown for fair price. We've already discussed that. But how do we know? Well, today's Memorial Day. We have to see where the Asia balance opens. And then we want to see if we're going to trade under that. Right? And we'll do an update and see where we went. And if we did, judging by the elongation of this trend day, there's the likelihood is that we're not going to complete the down move all in one day. The best we could hope for is a trade to the midpoint or the fair price at this stage, right? We're not probably going to anticipate more than that. That's the first thing. So we can easily deduce what this market's going to do as soon as we come into the Asia Open. And then what we looking to target, like I said, fair price, no less than value low, at least not on the first one. We have to form an offer stack at a later stage to confirm the bearish movement long term. But for now, we just want that short play where we can take some pips out of the market, basically, because we know that this market is still pretty bullish. It's running into stops now. And on the longer term cycle, that's the case. And we'll look at that in the next lecture. But that's where we are. Right, so we can start to see those levels of interest. Right, the next point, of course, will be the bid stack, where we're going to look at potentially the next draw on liquidity, and then maybe a small rally, and then maybe a continuation to this bid stack, and then finally we might come down here and then take out the lows before rallying. In fact, we have a potential of taking out the 133s. But again, there's another layer of analysis we need to look at if we're going to confirm that. Right, again, what's the upside risk? If we break and we hold this level and we start to trade above value high and we get an Asian range break, then there's a good chance we get some more continuation, but my guess is that it will probably be the last one before we start to head lower. Right, so we're already really, really long at this stage. The advantages in having the short side trade. I hope this is making sense to traders now, right? We're making some headway. So I've looked at examples on a commodity market and a currency market, and it's not any different. Pretty much the same. And we're going to cover examples on indices, the NASDAQ. We're going to cover example on crude and gold, and you'll see that the same thing plays out for each asset class. Once again, if you have questions, use the comment section below. I will only put comments that are questions, genuine questions about what we talked about here, and I'll answer them. I'll look through them all. But if you're a marketer or you're just here to trick the algorithm to affect the videos, whatever it is, kids do these days, if you're one of those, your comment won't even show up because just don't bother. There would be no point. But if you put a comment, you had a question, I'll answer it, and that will be shared with the rest of the community. That's how I plan to run these series. So all the comments are going to be held back, and I'll check them to make sure they're genuine questions. If they're not, I'm not looking for, all of that crazy YouTube engagement from comments and all of that. I'm not really that interested. I just want to help people. So if anyone needs that help, just use the comments below. Join the Discord server, because then you can have regular commentaries on there on the free server. And then if you want to look at becoming a premium member, where you get a hell of a lot more and you get a lot more time with me, including Q&As and so on, then that's something that you should consider signing up to. And again, for me, it just supports the server that I run all this stuff on. It supports my time and all the information I'm trying to give you from all the years I've spent in the business. So again, if you guys are interested in doing that, then just head to the private members area. But for now, the free stuff is more than adequate to get you through. I think on this YouTube channel, I've got about 400 videos. I've removed some over the years just because I've done more updated, relevant versions. But I think this channel's been active since 2012. So it's been actively posted on since 2014. So you're looking at 11 years plus worth of information. Some of you guys have already been trading for a year or two. So the channel's been around longer than many of the influencers now, but again, like I said, I put genuine stuff out there. So unless you're doing a deep dive on market profile, you're not really going to find my YouTube channel. And if you do find a YouTube channel, I can guarantee you found the best resource ever, because you're going to have this learning in one place. No one else does market profile in this depth, in this context, better than this channel. Right? It's the only one you're going to find. Everybody else is doing this half-baked stuff, volume profiles, and stuff that works, I guess, to a point, but you're not getting a full understanding. You're not understanding how the market delivers its pricing mechanism. You're just not getting it. And at some point, a lot of you are going to agree with me, it's going to start feeling frustrating. You're not looking for a 90% win rate, but you do want to be able to make enough money so that you can make this a full-time venture. I'm a full-time trader. I don't do anything else. This is what I do, right? So if you want to also share that kind of dream, like everybody, most people got into finance because they wanted a degree of financial freedom, right? And they also wanted a degree of being able to call their own shots in life. They didn't want a boss. They didn't want any of those things. So if that's what you're looking for, then I'll give you all the tools to achieve that. And like I said, if you follow everything I tell you to do, you're going to make money and you're going to be able to realize that dream. Right? I know a lot of traders have so much money, like they're not really traders yet, but I know a lot of people have so much money on the sidelines that they could put into trading and could change their lives dramatically, but they're so scared. There are people who even go invest in real estate. I'm not saying real estate is a bad investment, but in some cases it is. In some cases it's not. But again, there's some people who would put large sums of money into real estate investments because they say apparently it's safe. It will always generate. But those same people could easily put some of that money into a trading account and make dramatic more return if they already knew what they were doing. The sad news is that lots of people don't know what they were doing despite being capital rich. So if you're one of those people, then I'm 99% certain that this channel is going to change your life, because you've got the money already. It's not a problem. What you need is someone to give you the know-how, right? Someone to really hold your hand and move with you. The other people who might small accounts, a lot of my channel is dedicated to small accounts, right? Because I honestly think that if you're looking at retirement, you're going to come into trading with a lot of money because you're looking at retirement. You've had 30, 40 years to accumulate a lot of wealth, and now you want to invest that. If you're 21 years old, you probably don't have a lot of money beyond student debt, or depending on the country you live in, maybe some student grants. And that's all you've got. But you want to be able to make money, maybe to help your family or something else. There's a lot of these situations now. But you don't have 10 grand, and it can be so annoying when people tell you that, you can't do this because you've got too little money, or you can't. It's all bullshit. It's just bollocks. If you can't make money with a small amount of money, you're never going to make money with a large amount of money. It's all about know-how. You can take these same principles and double your account. I'm not going to tell you it's easy to do, but once you've learned the principles, it is easy to do. You can take that same money, double your account, right? And that's a start. Once you've done that once, you can try and do it a second time. And once you're at a certain level, now you can start to really get technical. People don't ask the question, how do some of the funds, the huge funds today, they start with hundreds of millions. Yeah, of course, at some point in their cycle, they have to raise money. But most of the time, that first run into like 100K, for example, they could normally do themselves from a small capital base. I run a podcast, and in that podcast, I've interviewed so many traders who started with, 5-figure accounts, and, they got, 7-8-figure accounts very easily. Again, I use the word easily in a very loose term. I'm not saying it's going to be easy, but once you know what you're doing, it's easy enough. So a lot of the channels are dedicated to small accounts too. So I'm not just trying to say larger people can do it. So if you have a small amount of money, of course you're not going to make 50 grand, in the space of 3 or 6 months. But, let's make an example. Let's say you have a $5,000 account. You could do decent with that in a 2-3 month span. You could have funds that might not be life-changing, but enough to start growing your trading business, and then putting it into a place now where you can feel comfortable. Enough said. Till my next video. Adios.